This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Premier Trade FOREX Report with Scott Norse.
Good afternoon, traders. I'm Scott Norse here with your FOREX Report. We are wrapping up the week, the month, and the third quarter. Well, it certainly was a very bad week for the dollar with an even worse finish as the free fall continues. The Fed really pulled the floor out on the buck when it cut interest rates last week, creating an environment that almost guarantees a weaker dollar. With large deficits, slowing growth, and now falling rates, the greenback is less attractive than perhaps any time in recent history. This week's data confirmed that housing recession is only worsening, and most economists agree that it will be a long time before a significant rebound is seen. Other data was mixed, with a few upside and downside surprises. Weekly jobless claims were surprisingly low yesterday, and today's PCE indicated that core inflation remains tame. We also saw personal income and spending remain relatively strong in a separate report today, and Chicago PMI beat expectations. The technical picture for the greenback is anything but mixed, as the currency remains on a one-way path lower. One group that has been incredibly mixed is the yen cross pairs. These pairs have been bouncing around erratically both on daily and intraday chart. The yen has shown more weakness than strength, of course, as stocks continue to inch higher following last week's surge on the rate decision. However, we believe U.S. indexes are overvalued and in need of a correction. If the Dow-yen correlation holds, carry trades could unwind rather quickly. As for the dollar, we normally see the U.S. currency gain some buoyancy in this scenario. Now to the big picture. With stocks and carry trades trying to get back into full swing bullish trends, one might believe the recent credit crunch was a very minor event. It seems as though traders are as willing as ever to take on high levels of risk and think that the storm is behind us. Unfortunately, we are not so optimistic in our outlook for the U.S. or even the global economy. Most economists and experts in the credit market still believe we have only seen the beginning and more pain will stem from the subprime fallout. When one credit market guru was asked this week what inning we were in regarding the credit crunch, he laughed and answered, "We are still in the middle of the national anthem." Ultimately, the problem that began in the U.S. will hurt the domestic economy more than other major economies around the world. This will continue to weigh on the dollar, and we believe stocks cannot continue to defy gravity for much longer. In turn, we expect risk aversion to be a theme for at least part of October, which means carry trades could run into some real trouble. Traders should keep their eyes and ears open for any developments in this credit story to spark further panic. Till next week, have a great weekend. Take care.